Hi, this is Vijay Bambwani here, and I'm recording this studio on a Sunday morning from my residence. As you can make out from the chirping of the birds and the lovely cooing of the parrots and the miners and all outside my balcony. Now, this video is actually more a result of introspection, personal experiences over the recent weeks, and having a lot of time on my hands in the lockdown, being kind of boxed into a small work area. You have all the time to do a lot of research and reading up a lot. The crux of this video, the title of this video, I'm unsure. Should it be how to focus on not losing money? Or should it be, why don't I give too many recommendations nowadays? Or how do you trade an economic downturn? At the end of the day, I think the viewer should decide what should be the apt title of this video. I leave it to you. But let me begin. Some of the best hedge fund managers. Now, why do I keep bringing hedge funds into my conversations with you through these videos? Because I admire hedge funds a lot, especially the sensible ones out there who have a clear sense of purpose. Hedge funds collect 2.5% asset management fees, and they might even take a percentage of the profits earned. They follow a hurdle rate or a high watermark, which is, say, for example, 6%, which is the bank FD rate. As long as they make only up to the bank FD rate, they will not share any profits with you. But anything above that, they might share a percentage of the profits. Internationally, the going rate can be as high as 20%. Now, the very fact, and by the way, in India, hedge funds are not very welcome because SEBI allows only mutual funds, and that to buy and hold, not the short selling types. Your average hedge funds are the Wild West cowboys who are gunslingers, and they just go bang, 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 long, short, commodities, currencies, indices. They fire away at will and buy and sell anything that they want. The reason why I admire hedge funds is these are pure alpha boys. Alpha is the concept of absolute profit. There is no excuse for whether the market is up, down, sideways. You have to generate alpha or absolute profits. So in order that the hedge fund manager have an entitlement to ask you for 20% of the profit above 6%, there must be a profit above 6%. So these are guys who have to generate profits come what may. No matter what type market it is, they will try to make money. Of course, a lot of times things do go wrong, as invariably they will at the end of the day. But some of the better sensible hedge fund managers, you will be surprised to note, focus on not losing money. That is their primary endeavor, to not lose money. Now, a lot of people I've talked to, since I have a lot of time during the lockdown, I'm video chatting a lot with like-minded people, enriching my brains and learning a lot from the world around me. A lot of people in our conversations tend to get surprised when you tell them that we should try and focus on not losing money. Now, they say we are here to make money, which is true. We are here to make money. But think about it. Use the process of elimination. You trade, you focus on not losing money. What's left? You've eliminated not losing money. You're continuing to trade. What's left? Making money. So if you focus on not losing money and continue to do what you need to do, there is a high degree of probability. I'm saying probability, not a guarantee. There's a high degree of probability that you will wind up making a lot more money than you would have under normal circumstances. Let's go back in time in the year 2008. I distinctly remember the Nifty peaked out in January 2008 at 6,357 points. It bottomed out in October close to 2,250 odd points. That was a sharp fall, a big fall. What if, hypothetically speaking, what if you were to get off the bus called the Nifty at say 10 to 15% lower than the peak? Now that's a fair kind of an assessment. 10 to 15% lower than the peak. By then you would have known that the Nifty is slip sliding away. I'm not going to insult your intellect by telling you to get out at the absolute peak. That's not possible. What if you were to get out 10 to 15% below the peak and re-enter the market? 10 to 15% higher than the bottom. Now that's a fair assessment also. You know what? You would have been far ahead of that cousin who you admire, envy, or even subconsciously try to compete with. The cousin who had held on to all his holdings in 2008, believing in the Warren Buffett way. I got nothing against Warren Buffett, by the way. Believing in the Warren Buffett way that you should let your investments ride. But then that was a steep decline of over 60%. What if you had got out 10-15% lower, got in 10-15% earlier? You would have had a head start over somebody who allowed all his stocks to bleed all the way down and take its own sweet time recovering up there. Even if you were to withdraw this money by February or March 2008 and deploy it in a fixed deposit, and believe me, in those days, in 2008, it was easy for you to get 8% per annum fixed deposits interest. You were much better off than the guy who allowed himself to ride all the way down. So focusing on not losing money should actually be high on our priority agenda, which is why there are times like the present ones, I do not give out recommendations because I don't think the probability of making money is seriously high enough. I believe in deploying statistical measures, statistical tools while trading. Now, one of the finest tools that I believe in is the Jensen's measure. It's very simple, actually. Are you being rewarded by the market by 1 unit of profit for every unit of risk that you are taking to earn that profit? If the answer is yes, if you are getting rewarded by 1 unit of profit for every unit of risk, by all means go ahead and do it. If the return is more than 1 unit for every unit of risk taken, probably you should borrow money and invest. By borrowing money, I mean leverage. Take it in futures and options. But in today's day, when the statistical beta or the sheer price volatility is as high as it is, by the way, the Bank Nifty is the number 2 highest volatile counter on the entire NSE. Now that's an index. You might say it's a very narrow index. It comprises only 10 stocks. Fine. Let me tell you about the Nifty 50. Broader than the BSE 30 index. Comprises 50 stocks. It's at number 8 on my statistical beta list. That kind of volatility, I believe, even professionals may not be able to handle. You as a retail investor or a retail trader have very, very hostile odds if you're playing in this market and trying to make money. Your focus currently should be to stay alive, hang in there, and live to fight another day. I noticed something in financial year 2019-20. In my weekly cash alert service, we began well in April 2019. We had a mediocre 2019 May, but June, July, and August were terrible. Now, in hindsight, it's very easy to know why. Because industrial metals, which is aluminium, copper, lead, nickel, zinc, were going in for delivery-based settlement. The lot sizes were being increased. For example, copper, which was 1,000 kilos, was going into 2,500 kilos. Margins were being raised and the market was going into a state of shock. Oil markets were extremely volatile, right? So we had a terrible June, July, August period. I tried to pull back on the number of recommendations. It was only after September, right up to 2nd of March, that not only did we recover all the money lost, but we ended the year with a near 43% net gain. Which tells me that a trader who waits for the appropriate moment before firing on all cylinders actually has a better statistical chance of making higher returns per annum than somebody who keeps trading all the time. I keep telling you to monitor the pulse of the market. Keep your finger on the pulse of the market. That's not the same as trade every day. Watch the market, but trade when the odds are completely in your favor. Before I sign off from this video, let me remind you to click like on this video. If you're watching it on YouTube, in the comment section, let me know what you think of this video and what else you would want me to record in the future. Do not forget to share this video with your family and friends and help me spread the cult of knowledge-based trading and investments. Don't forget to join Equity Master's Telegram channel with the handle Equity Master Official. I put up a couple of updates every day, Monday to Friday, and I would love you to read them. Vijay Bambwani signing off from now. Till we meet again in my next video, do take very good care of yourself, your trades and your investments. Thank you. Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.